Chapter 3, Adjusting the Accounts. In Chapter 3, we're going to look at the adjusting entries that would need to be made in our accounting records if we were about to prepare financial statements. The first learning objective in Chapter 3, we're going to look at what the time period assumption tells us. Then we're going to talk about what accrual basis of accounting is. We're then going to look at the different types of adjusting entries that would need to be made. We're going to first look at deferrals and then our accruals. And finally, we're going to talk then about the adjusted trial balance. In chapters 1 and 2, we started looking at the steps in the accounting cycle. In chapter 1, we talked about analyzing our transactions. In chapter 1, in our analysis, we looked at the accounts that would be affected and whether those accounts were increasing or decreasing, and was our accounting equation still in balance. In chapter 2, we added to our analysis the rules of debit and credit for our different types of accounts, and knowing the debits and credits, then that would allow us to record our entries in our journal, journalizing our transactions. Those journal transactions would then get posted to the general ledger. And at the end of chapter 2, we talked about the preparation of the trial balance, which was just the listing of all of our accounts and their balance, either debit or credit, totaling up our debits, totaling up our credits, debits equal credits. Now in this chapter, we're going to talk about the adjustments that would need to be made if we were about to prepare financial statements, because we want our financial statements to be as accurate as possible. And even though we've recorded our entries just perfectly in our journal and our general ledger, if we're going to prepare financial statements, we're going to need to make some adjustments to some of our accounts. Although we've recorded things just perfectly, some of our accounts are really not accurate. These adjusting journal entries will get journalized and posted in our journal and ledger just like our normal transactions would. After we prepare these adjusting entries and post them to our general ledger, we would then prepare an adjusted trial balance. We're going to talk about this at the end of this chapter. The adjusted trial balance is going to look like our trial balance did, except we would have made some adjustments to various accounts, and we may even have some new accounts with balances in them as well. And then, of course, from this adjusted trial balance, we can prepare 3 of our 4 financial statements: our income statement, our retained earnings statement, and our balance sheet. Remember, we're still going to need to keep in mind our rules of debit and credit for our different types of accounts. Common stock and retained earnings is in our stockholders' equity, and of course our retained earnings is made up of our revenue minus our expenses minus our dividends. So the sooner you memorize these rules, the better off you're going to be. Practice them if you have to, but the sooner you learn it, the better off you're going to be. So we got to keep these rules in mind as we talk about our different adjusting entries. Here in chapter 3, we have another assumption to talk about called the time period assumption. The time period assumption simply states that accountants are going to divide the economic life of a business up into artificial time periods. Every business is going to have to prepare annual financial statements because they're going to need to report to the IRS the results of their operations for the year as they prepare their tax returns. But a lot of businesses will prepare monthly financial statements, keeping track of how they're doing on a month-by-month basis, or perhaps even quarterly financial statements every 3 months, again, to keep track of the operations of the business. Now, these monthly or quarterly time periods are called interim periods, and if you're preparing financial statements, they're called interim financial statements. A business can choose its fiscal year to be any 12-month period. It could be a calendar year fiscal year that would run from January 1st through December 31st, or their fiscal year could be another 12-month time period. For example, their fiscal year could be from July the 1st in one year and run through June the 30th of the next year. Every business can choose that as it establishes its accounting system. Now, a lot of businesses will choose to have their fiscal year end at a time of the year when they're least busy. They're having to get things prepared for perhaps auditors to come in and do their annual audit. They're having to get stuff ready for their tax accountant. So they don't want that to be their busiest time of the year. So they'll have that year end at a slow time. For instance, a ski resort would probably not choose December 31 as their fiscal year end. That's their busiest time of the year. Probably a better year end for a ski resort would be June 30th, when things are a little bit slow around the old ski resort. Walmart, for example. I don't know if Walmart has a slow period, but Walmart has chosen January 31 each year to be their year end. I guess they've made it through their Christmas and their Christmas sales and their Christmas returns, and half the country may be snowed in, and so January 31 is their year end, figuring that February is going to be a slow time of the year for them. Okay, our first question in Chapter 3. The time period assumption states that hopefully you picked answer choice C. The economic life of a business can be divided into artificial time periods. Now, whether you realize it or not, you've been recording entries under the accrual basis of accounting from the beginning of this course. We didn't call it that, but the accrual basis of accounting means we're going to record revenues in the time period in which they are earned, not when cash is received, and we're going to record expenses when they are incurred, not when we pay for them. If you'll remember, when we did work for a customer and the customer was going to pay us later, we went in there and debited accounts receivable and credited our service revenue account. Okay? We haven't received cash payment yet, but under the accrual basis, we recognize revenue as we do the work. The reason we're going to do this is we're incurring expenses to help us earn that revenue, so we're going to be recording the expenses in that same time period as well, and we're getting a good matching of revenues and their associated expenses. Now, opposite of the accrual basis of accounting would be the cash basis of accounting. Cash basis of accounting would be we record revenues when we receive cash payment, we record expenses when we pay out cash. The cash basis of accounting is not GAAP. Okay, it's not acceptable if we're preparing financial statements for people outside our organization to use. Now, if we're preparing financial statements and the only people that are going to use our financial statements are people inside the organization, we don't have to show anybody our financial information, then we might elect to use the cash basis. But if we're preparing our financial statements for use outside our business, we would need to follow the GAAP rules. Okay, associated with this accrual basis of accounting is the revenue recognition principle, which says we recognize revenue in the accounting period in which the performance obligation is satisfied. So if it's a service business, it's when we complete the performance obligation, whatever that might be. If it's a merchandising business, which we'll talk about beginning in Chapter 5, it's when we deliver the goods that are being purchased by our customer. Then we have the expense recognition principle, is we record expenses when they are incurred, not when we pay for them. We want to let our expenses match our revenues. Okay, we want to record them in the same time period that we incur the expense to produce the revenue. Okay, here's another question. The revenue recognition principle states that A, revenue should be recognized in the accounting period in which it is earned. Okay, here's another question. One of the following statements about the accrual basis of accounting is false. That statement is D, revenue is recorded only when cash is received and expenses are recorded only when cash is paid. Answer choice D describes the cash basis of accounting. All right, now let's talk about adjusting entries. Adjusting entries will need to be made anytime we are about to prepare our financial statements. The reasons is that we want to make sure that we're following our revenue recognition principle and our expense recognition principle. We want to make sure our revenues and expenses are being recorded in the proper time period, and we want to make sure that our trial balance has been brought up to date. Every adjusting entry that we're going to make is going to affect at least one income statement account and one balance sheet account. All right, remember the accounts that are going to appear on our income statement will be our revenue and expense accounts. So every adjusting entry will affect either a revenue or an expense account. And then remember, our balance sheet consists of our assets, liabilities, and our two stockholders' equity accounts, common stock and retained earnings. The balance sheet accounts that are going to be affected with our adjusting entries will either be an asset account or a liability account. All right, another question. Adjusting entries are made to ensure that correct answer is all of these reasons. We're doing our adjusting entries to make sure that our expenses are recorded in the proper time period, our revenues are recorded in the proper time period, and that our balance sheet and income statement accounts have correct balances as we're about to prepare our financial statements. This chart shows our two types of adjusting entries. We have deferral adjusting entries and accrual adjusting entries. Our deferral adjusting entries are made up of our prepaid expenses and our unearned revenues. Our accrual adjusting entries are made up of our accrued revenues and our accrued expenses. You can see the definition for our prepaid expenses. These are expenses that are paid in cash before they are used up or consumed. Our unearned revenues, if you will recall, are our revenues that we've received payment for work that's going to be done but has not yet been done. And then our accrued revenues are going to be our revenues that we've earned. We haven't been paid for them, nor have we recorded them in our accounting records. Our accrued expenses are expenses that have been incurred, but they have not been paid for, nor have they been recorded in our accounting system. This will make a little more sense to you as we go through some different examples. This is our trial balance that we looked at the end of Chapter 2. Remember, we prepared the trial balance as our fourth step in the accounting cycle. We've analyzed all the transactions that have occurred within our business during this period of time. We've recorded those, we've journalized those transactions in our general journal, and then posted all of those journal entries into our general ledger accounts. And these are our ending account balances for all of our asset accounts, our liability accounts, our common stock account. Of course, our retained earnings account has a zero balance since this business just started here in the month of October. Our dividends account balance, and then our revenues and our expenses. Remember, our debits have to equal our credits. Even if we've recorded all of our entries properly, some of our balances need to be brought up to date. Now, just looking at this, it's kind of hard to see which balances need to be brought up to date, but people inside the organization are going to analyze these account balances and see which ones need to be adjusted. Now let's look in more detail at our deferral adjusting entries. Our deferrals are going to be our expenses or revenues that are going to be recognized at some point in the future, even though cash has been transferred initially. And remember, our two types of deferral adjusting entries are for our prepaid expenses and our unearned revenues. Let's first look at our prepaid expenses. These are expenses that are paid in advance, and these expenses are going to benefit more than one accounting period. Some examples of some prepaid expenses include our prepaid insurance, prepaid our supplies, we could have prepaid advertising, prepaid rent. Our purchase of equipment or buildings, these are called fixed assets, or sometimes it's referred to as plant assets. These are things that we buy that's going to last us for a good number of years. We're going to talk more specifically about our fixed assets when we get to Chapter 9. All right, let's look at our prepaid expenses. Our prepaid expenses will expire either with the passage of time or through usage. Our adjusting entry for our prepaid expenses will include an increase to our expense account, which we know would be a debit, and a credit to some type of asset account, with one exception. When we talk about our depreciation here in a few moments, we'll see that we don't credit an asset account, we'll credit something called a contra asset account. We'll see that here in a few moments. All right, here's our first example. If we recall, the Pioneer Advertising Agency had purchased some supplies which cost $2,500. And when we recorded that entry, we debited the asset account supplies. All right. If you'll think about this, at the end of the month of October, do you think Pioneer Advertising Agency still has $2,500 worth of supplies? Well, no, they more than likely do not. The reason they do not is that they've probably used some of these supplies during the month of October. So we can find out how many supplies have been used by going in and taking an inventory of the supplies we still have on hand. And in this example, it shows that they had $1,000 worth of supplies still on hand. That tells us that $1,500 worth of supplies have been used during the month of October. So to record that usage, we're going to go in and debit supplies expense for $1,500. This will put the supplies used into an expense account, and then we're going to credit the asset account supplies. Let's analyze the transaction. Okay, we said our supplies expense account is going to be affected. Our asset account supplies is going to be affected. Our asset account is decreasing, and our supplies expense account decreases our stockholders' equity because it decreases retained earnings. We learned in Chapter 2 that increasing our expense account involves us debiting that expense account, and decreasing our asset involves a credit to the asset account supplies. There is the adjusting journal entry that we would record, and then we're going to use T accounts to represent our general ledger. So by posting this adjusting entry to our general ledger, you can see it reduces our supplies account balance down to the amount we have on hand, $1,000, and then records into our expense account the amount of supplies that have been used up. Now in real life, most businesses don't record the purchase of supplies into a supplies asset account. Most businesses go ahead and expense out supplies as they purchase them. The reason for this is for many businesses, the supplies account balance is going to be very small. It's going to be kind of immaterial to the size of the company, so it's not worth keeping up with this small amount in order to be this precise. You can imagine having the job each month you had to go around and count up the supplies that you still have on hand. That would be a very tedious job for someone, would take someone a lot of time to do for very little benefit. So again, in real life, supplies are expensed when they're purchased, but for the purposes of this class, we're going to do this as accurately as we can and record it into an asset account first and then expense it out as the supplies get used up. Okay, our next example of a prepaid expense is insurance that the Pioneer Advertising Agency has bought. If you remember, back in Chapter 2, when Pioneer bought insurance, they paid $600 for a one-year fire insurance policy. Coverage began on the first day of October. If you'll think about this, the day they purchased this insurance policy, the insurance company had not done anything to earn this money, and we have really not received any coverage yet. So by putting it into this asset account and then expensing it out over the life of the insurance policy, in this case 1 year, we will allocate this insurance cost to each month for the next 12 months. So we take the $600 and divide it by 12 months. We're going to go in and record $50 worth of insurance expense each month for the next 12 months, as you can see over here. Our adjusting entry will be to debit the insurance expense account for $50 and credit the asset account prepaid insurance. Now, we have received 1 month's worth of coverage, so we're recording that expense. Now, from the insurance company's standpoint, this prepayment we've made to them is an unearned revenue. So when one business has a prepaid expense, another business will have an unearned revenue. Let's look at the analysis here, okay? Our expense account is affected, and expenses decrease our stockholders' equity. And our prepaid insurance account is an asset account, it's decreasing. So our accounting equation remains in balance. We increase our expense accounts with debits and decrease our asset accounts with credits. So that's our debit and credit analysis. There would be the adjusting journal entry we would record. And then posting that entry, again using T accounts as our representative of our general ledger. By crediting the prepaid insurance account, we reduce our prepaid insurance account balance down to $550, and by debiting the insurance expense, we record the amount of insurance that has been used up. We would make this entry every month for the next 12 months until the end of 12 months, this prepaid insurance balance will be down to 0. Let's talk now about depreciation and fixed assets. Fixed assets are assets that we purchase that we're going to be able to use in our business for probably a good number of years. We're going to record them as asset accounts as we buy them, but as the assets get used up, we're going to do what's called depreciate these fixed assets. Depreciation is the process of allocating the cost of a fixed asset to an expense over its useful life. It has nothing to do with what the asset is worth. It's just allocating the cost to expense. If you think about this, let's say we bought a piece of equipment that was going to assist us in our business to produce revenue for the next 5 years. If we went in and debited equipment expense and credited cash, then we would record all of that expense into the first year. The asset's going to be used for the next 5 years to help us produce revenue in our business. So by not recording it as an asset, but recording it as an expense when we first buy it, we would be putting all of the expense into 1 year, even though this equipment would be earning revenue for our business for 5 years. So by putting it into an asset account and depreciating it, we're going to allocate the cost of that fixed asset to expense over its useful life. In Chapter 9, we're going to talk about how to calculate depreciation, but for our purposes here in Chapter 3 and looking at our adjusting entry, we are given the depreciation information, and it tells us that Pioneer Advertising Agency is going to depreciate their equipment $480 per year or $40 per month. So to record our depreciation, we're going to debit depreciation expense. And we're going to credit not an asset account, but a contra asset account. A contra asset account is contra to the asset account equipment. Okay, so the rules of debit and credit for a contra asset account are going to be opposite of the asset accounts. So by crediting accumulated depreciation, we are increasing the accumulated depreciation account. Let's do the analysis. Okay, we're going to increase our depreciation expense, which causes a decrease in our stockholders' equity, and we're going to increase our accumulated depreciation, but it's contra to our asset account, so it's reducing our assets. So we have minus and minus here in our equation analysis. We increase our expense accounts with debits. We increase our contra asset account accumulated depreciation with credits. This would be our adjusting journal entry, and then when we record this adjusting journal entry into our general ledger, it does not affect the equipment account, remember. It's going to affect the contra asset account equipment account. So we credit that account and we debit our depreciation expense. On our balance sheet, here is how we would present that equipment account and that contra asset account accumulated depreciation equipment. We're going to show the cost of our equipment, and then we're going to subtract our accumulated depreciation on that equipment and show this what's called book value of our equipment on our balance sheet, this $4,960. When we get into Chapter 9 and talk about fixed assets, you will see why we need to keep our accumulated depreciation separate from our equipment account. So, accounting for our prepaid expenses, here are some examples that we've looked at. Didn't look at all of them, but here's some of them we looked at. Why we need to adjust these accounts, how these accounts appear before our adjustment, and what our adjusting entry is going to look like. Debiting an expense account and crediting an asset account, or in the case of our fixed assets like equipment and buildings, a contra asset account. All right, now let's look at our other type of deferral adjusting entry, unearned revenues. Remember, an unearned revenue occurs when a business receives a payment of cash, but they have not done any work to earn that. So this amount that has been received will be recorded as a liability and not transferred over to a revenue until work has actually been done. There's some different examples of what could be unearned revenue. Someone pays us rent in advance. Airline tickets paid in advance. Magazine subscriptions are a good example. We buy a subscription to a magazine, a 12-month subscription, and it's a monthly magazine. We pay the magazine publisher an amount in advance for 1 year's worth of magazines. Okay? To the magazine publisher, that is an unearned revenue. When they mail out the magazines each month, they're going to recognize 1/12 of that amount that we've paid in. Until the end of the year, they would have recognized it in full. And of course, customer deposits would be another example. Our adjusting entry for our unearned revenue is going to require us to analyze the unearned revenue account and make the determination whether or not any work has actually been done. We could analyze this account, and if we've not done any of the work, then there's no adjusting entry to be made. But if we analyze the account, see that we've done a portion of the work, this adjusting entry is going to involve us debiting that liability account, unearned revenue, and crediting our revenue account. Now let's look at Pioneer Advertising Agency. If you will recall, Pioneer had received a $1,200 advance from a customer, RKnox, for advertising services that were going to be completed by December the 31st. An analysis of this account, this $1,200 balance in our liability account, unearned service revenue, shows that they've actually done 1/3 of the work, or $400 worth of the work. So that needs to be recognized. The recognition will cause us to debit our unearned service revenue account $400 and credit our service revenue account $400. Here's the analysis. Our liability account is decreasing and our service revenue increases our stockholders' equity. So there's our equation analysis. We know debits decrease our liability accounts and credits increase our revenue accounts. There's our debit credit analysis. This is the adjusting journal entry we would record. And then the posting of that entry, you can see here, is going to cause our unearned service revenue balance to go from $1,200 down to $800. This is how much work that Pioneer Advertising Agency still needs to do for RNOX. And then, of course, crediting our service revenue recognizes that work that has been done during the month of October. This gets our revenue recorded and our liability decreased. Here's a summary of our unearned revenues. The different examples, why we need to adjust our unearned revenue, how our accounts appear before we adjust them, and what our adjusting entry is going to involve. I'm not going to put a lot of these in the PowerPoint presentations here, but this one has always kind of fascinated me. If you read your chapter before this discussion, which I'm sure every one of you did, you would have hopefully come across this, and I always recommend you to read these real-life situations because a lot of them are very interesting. But this has to do with gift cards. Gift cards represent unearned revenue to the company that has sold the gift card. Because if you think about it, has the company done anything to earn revenue? No. They won't earn revenue until the gift card is used. So gift cards represent a prepayment to, in this case, Best Buy. And what is really fascinating about this, in my opinion, is that, and this is several years old, you can see back a number of years ago, Best Buy showed on their balance sheet unearned revenues related to gift cards of $479 million. That is a lot of unused gift cards. Of course, retailers like to sell gift cards. Number one, they receive the cash in advance, and so they can make use of that money. It forces the recipient of the gift card to come and shop in their store. So it targets people to come to specifically shop with them. And of course, gift cards can be lost, never used, and so the company continues to be able to hold this cash that they've already received and use it without any real cost to them. Now let's look at our accrual adjusting entries. Remember, our two types of accrual adjusting entries are our accrued revenues, which would be revenues for work that has been done but has not yet been recorded, obviously, and we haven't received payment yet. Accrued expenses are expenses that have been incurred, but we haven't paid for them yet, nor have we gotten them recorded. You may be asking yourself, well, why haven't they recorded these accrued revenues or accrued expenses? Let me give you an example of each of these, and then we'll look at some more specific ones as they relate to our Pioneer Advertising Agency. Let's say there's a business that has some excess cash during the year, and they decide they don't really need that cash for any specific purpose. Now, this is a timeline. This is January the 1st. This is December the 31st. Let's say this business wants to take this excess cash, say it's $10,000, and they're going to take that $10,000 and they're going to go to a bank or some financial institution and buy what's called a certificate of deposit. A certificate of deposit, or a CD as it's known, not a compact disc. This is a certificate of deposit. And when they purchase this certificate of deposit, they're basically telling the bank, we agree to leave this money in your bank for a specific period of time, and you will pay us a certain interest. And usually the interest rates on CDs are going to be higher than you can get on other types of interest-bearing accounts. Let's say they go in on July the 1st and purchase this 1-year CD. So they're buying it on July the 1st during this current year. The CD will not mature until June the 30th of the next year. So for the next 12 months, this money will remain on deposit with the bank and be earning interest. Okay, let's say this CD is paying, this $10,000 CD is paying 5% interest. That's kind of high for today's interest rates, but let's just say 5%. So when this CD matures in 1 year, the bank is going to pay us $10,500. The principal amount of $10,000 plus $500 in interest. Okay, so we're not going to receive that $500 in interest though until a year has gone by. But let's say this business is preparing our financial statements as of December the 31st. Well, has our business earned any interest revenue? Well, yes, it has. It has earned approximately $250 worth here in the 6 months between July the 1st and December the 31st. But we're not going to receive this interest until June the 30th of the next year. So we need to record this accrued revenue as we're doing our financial statements here as of December the 31st. It's revenue that's been earned, but we have not received it, nor have we gotten it recorded yet. Now let's use another banking example to talk about an accrued expense. Again, we're looking at a 1-year timeline. Instead of this business depositing $10,000 into a bank and earning interest on it, it borrows money. So on July the 1st, it borrows $10,000, and they're borrowing it for 1 year. And the interest rate on this loan, let's just say it's 10%. So when this loan becomes due in 1 year, so June the 30th of the next year, we're going to have to pay back $11,000, $10,000 in principal plus $1,000 or 10% interest. Okay, so if we're preparing our financial statements here on December the 31st, we need to record how much interest has been charged to us. Well, approximately $500 in interest. We've incurred that expense, but we're not going to pay this interest until the note matures a year from this July the 1st. So to record the proper amount of interest expense into our current year, we need to make this accrued expense adjusting entry because we're preparing our financial statements here on December the 31st. So this is an example of an expense that has been incurred but not yet recorded until we make this adjusting entry. Okay, let's talk specifically about accrued revenues. Again, accrued revenues are revenues that have been earned, but we've not received payment for them yet, nor have we gotten these revenues recorded. And some examples would be rent, interest, interest, which we looked at a few moments ago on our CD example, and it could be for services that have been performed, work that our business has done for a customer, but we don't have it recorded yet. Our adjusting entries for our accrued revenue is going to require us to increase an asset account, and this is going to be some type of receivable. In our CD example, it would be called interest receivable. If it was work that we do for a customer, it would just be called accounts receivable. So we're going to increase an asset account, a receivable account, and increase a revenue account. Okay, in our Pioneer Advertising Agency example, it tells us here that Pioneer has done $200 worth of work for a client, but have not billed them out. If they'd billed it out, then they would have recorded it. So they haven't billed it yet. And so here at the end of October, they realize they've done this work. So they're going to go in and debit accounts receivable, increasing that asset account, accounts receivable, and increasing that revenue account, service revenue. And then, of course, if they receive payment for this later, they're going to go in and debit cash, credit accounts receivable. Here is the analysis of that transaction. Again, our asset account, accounts receivable is increasing. Our service revenue is also increasing. So there's our equation analysis. Our debit and credit analysis, we're increasing an asset account with a debit, increasing our revenue account with the credit. This would be our adjusting journal entry, and then posting that entry again into T accounts that represents our general ledger. Okay, here are some of our different examples of our accrued revenue adjusting entries, why we need to adjust for them, how our counts appear before we've adjusted them, and what our adjusting entry would be. Let's look at accrued expenses. Remember, accrued expenses are expenses that have been incurred, but we haven't paid for them yet, nor do we have them recorded. Some different examples include interest, like our loan example that I showed earlier. It could be related to taxes, and we're going to look at a very common accrued expense that needs to be recorded. It's going to be salaries to our employees. Our adjusting entry for our accrued expenses is going to involve us debiting or increasing an expense account and crediting a liability account, some type of payable, and that will be increasing that liability account. Okay, if you will remember back in Chapter 2, Pioneer Advertising Agency signed a 3-month note payable in the amount of $5,000. They did that on October the 1st, and the annual interest rate on that loan is 12%. To calculate 1 month's worth of interest, which Pioneer has incurred that cost during the month of October, we take the face amount of the note times the annual interest rate times time expressed in terms of a year. So this would be 1/12, 1 month out of 12. So remember, the formula for interest is principal of the loan times the interest rate times time. Because our interest rate is expressed in terms of an annual interest rate, time has to be expressed in terms of a year. In this case, 1 month or 1/12. And we see the calculation of our monthly interest is $50. So Pioneer Advertising Agency has incurred this cost. They are not going to pay this interest until this note matures at the end of this 3-month period. So the journal entry that Pioneer, or the adjusting journal entry that Pioneer will record, would have us debiting our interest expense and crediting a liability account called interest payable. Here is the analysis. Our interest expense, that decreases our stockholders' equity, and our liability account is increasing. So there's our equation analysis. We increase our expense accounts with debits, increase our liability accounts with credits. There would be our adjusting journal entry, and as we post that entry into our general ledger, we record our debit to our interest expense and our credit to our liability account, interest payable. Okay, another common adjusting entry related to an accrued expense is for salary and wages. In our example, it tells us that Pioneer has paid the salary and wages for their employees on October the 26th. So they apparently pay their employees on a bi-weekly basis. So every 2 weeks they pay their employees. So here they've made this payment to their employees for October the 26th. The next payroll is going to be 2 weeks later here on November the 9th. Okay, that November the 9th payroll is actually going to include 3 days where work was actually done in the month of October. So we need to get these 3 days worth of salary and wages that our employees have earned into the proper time period, the month of October, and that's going to amount to $1,200, because you can see if our total salaries are $2,000 for a 5-day work week, that's $400 per day, so 3 days worth is going to be this $1,200. Here's the analysis. We need to record an entry to our salary and wages expense, and salary and wages expense is going to decrease our stockholders' equity and increase a liability account called salary and wages payable. So there's our equation analysis. We increase expenses with debits, increase liabilities with credits. There's our debit credit analysis. Here is the adjusting entry we would record in our journal, and then posting that entry to our general ledger. It's going to show that liability as of October 31st and record this 3 days worth of salary and wages expense into the proper time period, the month of October. Here's a question. Adjustments for accrued revenues have an assets and revenues account relationship. Remember, we're going to be increasing a revenue account to record this revenue that's been earned but not yet recorded, and then the asset account that will be affected will be some type of receivable. Okay, here's a summary of our accrued expenses. Some different examples. Why we need to make the adjustment, how our accounts appear before we adjust them, and what our adjusting entry is going to be. Here's a summary of our different types of adjusting entries. We had our 2 deferral adjusting entries, prepaid expenses and unearned revenues, and we had 2 types of accrual adjusting entries, accrued revenues and accrued expenses. This shows how our accounts appear before they are adjusted and what our adjusting entry is going to look like. After we have analyzed, journalized, and recorded or posted to our general ledger all of our adjusting entries, we will now then need to prepare what's called an adjusted trial balance. And the adjusted trial balance, as I said earlier, will look very similar to our trial balance in its format, but we will have made adjustments to various account balances, as we looked at in our earlier slides, and we may even have some accounts that have balances that did not have a balance in our trial balance. We can then prepare our financial statements, or at least our income statement, retained earnings statement, and balance sheet from this adjusted trial balance. After we have analyzed, journalized, and posted our adjusting entries into our general ledger, we can then prepare this adjusted trial balance by taking our general ledger balances for all of our different accounts, list them here on this adjusted trial balance. Our accounts that are going to have debit balances include our different asset accounts, our dividends account, and all of our different expense accounts. Remember, a lot of these accounts didn't even appear on our trial balance because they did not have a balance at the time of the trial balance preparation. Of course, our credit balance items are going to include this contra asset account, accumulated depreciation, all of our different liability accounts, our common stock account, our revenue account. Of course, our retained earnings account would normally have a credit balance, but we haven't made any entries to our retained earnings account, so that balance is 0 at this time. Our debits have to equal our credits in our adjusted trial balance. Now let's look at preparing our 3 of our 4 financial statements from our adjusted trial balance. First, our income statement. Remember, our income statement is going to record our revenues minus our expenses. That's going to give us a calculation of our net income if revenues exceed expenses, or a net loss if our expenses exceed our revenues. That net income or net loss is going to appear on our retained earnings statement, so we would prepare it next. Remember, our retained earnings statement, we show our beginning retained earnings balance plus any net income that has been earned during the period, or minus any net loss that we might have had, minus any dividends that might have been paid out. That's going to give us our ending retained earnings balance. And then thirdly, we would prepare our balance sheet. Our balance sheet is our accounting equation. We show our assets, we total them. We show our liabilities, we total those. We show our stockholders' equity accounts, we total that. We add together our liabilities plus our stockholders' equity, and then our total assets needs to equal our total liabilities plus our stockholders' equity. Remember, our retained earnings balance is retained earnings statement is prepared second because this retained earnings balance is going to appear on our balance sheet. This slide shows 2 of our 3 financial statements. First, our income statement. Again, this income statement is for the month ended October 31. We show first our revenues, then our expenses. This is our total expense, our total expenses. We subtract our total expenses from our total revenue, and that gives us this net income. We only have 1 revenue account here. If we had multiple revenue accounts, we would list them below here and then show a total revenues line item. But we just have 1 revenue account, so we can show it like this. This net income is going to appear here in our retained earnings statement. But again, our retained earnings statement is going to be our beginning retained earnings, which at the beginning of October, since this business just got started this month, is 0. So we're starting off with a 0 balance. We add this net income, subtract out our dividends that have been paid, and that gives us this ending retained earnings balance of $2,360. This retained earnings balance shown on a retained earnings statement is going to appear in the stockholders' equity section of our balance sheet. Now here is our balance sheet. Remember, our balance sheet is prepared as to one point in time. So at the close of business on October 31st, these are the balances in all of our asset, liability, and stockholders' equity accounts. We first list our assets. Remember, our equipment account, we're going to subtract out this accumulated depreciation that we recorded so that we show our book value here on our equipment. We total our assets and see our total assets is $21,910. Then from our adjusted trial balance, we list our different liability accounts, total those. We list our stockholders' equity accounts, our common stock account, and then our retained earnings account balance is coming from our statement of retained earnings. We total those up and we get total stockholders' equity of $12,360. We add that to our total liabilities of $9,550, and we get total liabilities and stockholders' equity of $21,910, which has to agree with our total assets. This concludes Chapter 3 on our adjusting entries.